In July 2020, a pristine 1988 BMW E30 M3 sold at auction for $250,000. That price did not reflect rarity alone. It reflected what happens when a homologation special stops behaving like a car and starts behaving like a fixed supply asset. The E30 M3 only existed in the first place because 1980s FIA Group A racing homologation rules demanded it. It was a thinly veiled race car forced onto public roads. A homologation special built to satisfy a racing quota now trades like a frozen financial asset. How did a street-legal race car transition from a purely mechanical driving tool into a manipulated financial asset, leaving everyday enthusiasts priced out by Wall Street syndicates and pop culture hype? Welcome to Bare Block Chronicles, where we investigate the financial mechanics driving modern car culture. To understand the trap, you have to start at the factory. Because the E30 M3 was born under a rulebook modern automakers can no longer satisfy. It's a common misconception that modern automakers simply forgot how to build lightweight sports cars. The truth is far more bureaucratic. BMW moved production to the main Munich factory solely to meet the 5,000 unit racing quota. It was an industrial burden forced onto standard assembly lines. Manufacturers cannot legally build this car anymore. Start with the shape of the car. Proposed pedestrian head protection rules are pushing modern front ends higher and blunter, moving the industry away from the low sloping nose that defined the 1980s design. Then came side impact rules. FMVSS 214 forced thicker pillars, reinforced doors, and more crash structure in the body shell. Those changes improved safety, with research linking the rule to a 14% reduction in fatality risk. But they also helped end the lightweight door for good. Finally, the Environmental Protection Agency's footprint rules project an aggressive 55 equivalent miles per gallon by model year 2026. However, recent political volatility surrounding the proposed Safe Vehicles Rule 3 threatens these efficiency targets, creating massive manufacturing instability. Automakers face severe margin penalties. Consequently, building a compact, high-revving analog chassis is financially prohibitive for an automaker to justify to shareholders. The factory lines are dead. This hard supply cap fundamentally changed the vehicle's nature. It stopped being a depreciating consumer good and became a fixed supply commodity. Legal extinction froze the supply, but scarcity alone doesn't distort a market. The distortion begins when the cost of ownership breaks the logic of use. Keeping an extinct resource alive is punishing. The E30 M3 utilizes a 0.33 drag coefficient with bespoke body panels. It shares almost nothing with a standard commuter car. Today, discontinued original equipment parts are scarce, expensive, and increasingly concentrated in the hands of specialist collectors, restorers, and well-capitalized buyers. This reality raises the cost of keeping these cars in proper condition. Rebuilding the powertrain is a massive liability. The legendary S14 engine block traces its lineage back to the 1962 M10 architecture. Today, you face a minimum of $10,000 to $20,000 to overhaul this race-derived motor. There's also a massive financial delta between a mechanical baseline service and a comprehensive cosmetic restoration. Extensive paint and bodywork can erase the economics that collectors use to justify paying top-tier money. This severe cost structure forces a metamorphosis in buyer behavior. In practice, agreed value classic car insurance often comes with mileage limits and usage restrictions. This reinforces the logic of preserving the car rather than using it freely. The BMW E30 M3 transitions from a homologated driving tool into an unwearable Rolex. Parking massive amounts of capital in a non-yielding physical asset costs money over time. analytical buyers recognized the massive opportunity cost and inflation erosion incurred by holding $250,000 in a depreciating garage queen, rather than an interest-bearing index fund. By that point, the market is no longer rewarding use. It's rewarding to preserve, tell stories, and maintain status. Once the cost of using the car overwhelms the pleasure of driving it, ownership changes hands. The car stops being priced by engineering and starts being priced by story. Provenance becomes the primary metric. At a 2020 Barrett-Jackson event, the estate of the late actor Paul Walker sold an entire fleet of homologation vehicles. A 1995 lightweight model brought $385,000. A 1991 M3 previously owned by the actor sold privately for nearly $150,000. These transactions introduced a celebrity premium that ordinary sellers then sought to apply to standard asking prices. Then the music industry arrived. Rapper Travis Scott acquired a collector-grade E30 M3, modified it heavily with his Cactus Jack logo, and utilized it as a charity tax write-off. By that point, the value of the car was no longer being discussed primarily in terms of steering, balance, or engineering. It was being discussed as cultural capital. Once the market stopped rewarding use, the E30 M3 stopped behaving like a car and started behaving like a trophy. And trophies are priced by distorted signals, not driving value. The initial United States market run consisted of roughly 5,300 units. From that initial production, only a fraction survived the track days and deferred maintenance of the early 2000s. Now, introduce the volatile mechanics of thin market economics. Clear market behavior indicates aggressive price anchoring facilitated by fractional platforms. Companies like Rally Road initially offered a 1988 M3 at $47 per share, releasing exactly 3,000 shares to retail investors. They use extreme public auction spikes to justify initial public offering valuations of $141,000. However, these platforms fail to highlight secondary market liquidity constraints. Fractional shares routinely trade at steep discounts during secondary windows due to illiquidity. This dynamic traps retail capital long after the initial public relations hype subsides. The ultimate market distortion occurred when that museum-grade 1988 BMW E30 M3 sold for $250,000 on Bring a Trailer. The headlines spread quickly across enthusiast and auction media. The trap is instantly set. Suddenly, every seller sitting on a rust-prone E30 M3 thought their car was worth six figures. The reality is entirely different. Actuarial data from classic car insurers on platforms like Classic.com anchors the median clearing band for a standard E30 firmly between $75,000 and $86,000. Sellers ignore the data and set impossible reserves. Market data shows a descending ladder of consecutive failed auctions lacking met reserves. Bids stalled at $101,000, then $94,000, and finally $82,500. Pragmatic buyers walked away. The market froze completely. That's why the headline numbers are not the market. The real question is how an ordinary buyer navigates the gap between hype and the reality of ownership. For the everyday enthusiast caught in this trap, the financial reality requires strict discipline. If you're entering the E30 M3 market today, you must navigate the mechanical asset safely. First, completely ignore the top decile auction outliers. The highest prices are not the most representative prices. Those transactions say more about trophy bidding, capital concentration, and thin market behavior than they do about the value of a usable driver-grade car. Base your entry strictly on the actuarial median. Second, separate the mechanical reserve from the cosmetic reserve before negotiating. You must be able to absorb a $20,000 specialized engine and suspension overhaul without liquidating the asset. Third, calculate the carrying costs. budget explicitly for agreed value insurance restrictions and climate-controlled storage. Finally, recognize that celebrity provenance and fractional platform pricing are not usable comparables. The real scarcity isn't the production volume. The real scarcity is a usable, properly sorted car. Once you separate the trophy market from the usable car market, the BMW E30 M3 stops looking like a dream purchase and starts looking like a case study. The E30 M3's value didn't rise due to increased utility, it rose because it became irreplaceable. Top sale headlines are not the market, they're thin market outliers mistaken for consensus. An extinct car becomes a trophy first, then a ghost comp, then a trap. A $250,000 garage queen is not appreciating capital, it's trapped capital. This is Bare Block Chronicles. If you want to understand the actual financial mechanics dictating car culture today, hit subscribe and leave a comment below. What extinct chassis should we investigate next?